Back in 2016, we were still in the era when interest rates would never rise, and in fact could never rise because the Fed had boxed itself in and would never be able to raise rates more than just a tiny symbolical bit. And people said that the interest rate on 30-year fixed rate mortgages would never ever go back to 5% again. That time was over, they said, and they assured us that at the smallest uptick in mortgage rates, the Fed would start QE4. And now the average interest rate on 30-year fixed-rate mortgages just rose above 5%. The Fed is still raising rates, quote-unquote, gradually, and will continue to do so for a while longer. And the Fed is unwinding QE, including shedding its mortgage-backed securities that it had acquired to push down mortgage rates. What will this do to the housing market? I am Wolf Richter of WOLFSTREET.com, and this is the Wolf Street Report. Home prices have risen 6% this year, according to the Case-Shiller Index. They're now up 11% from the peak of the prior housing bubble, the housing bubble that I call Housing Bubble 1 because it was the first one this century. So with home prices being 11% above the prior bubble, what's the big deal? I constantly hear that. But there are three elements here. First, the peak of the prior bubble was really the peak of the craziest housing bubble we have seen, and it is not some sort of serene state of calm that we want to return to. The peak of the prior housing bubble led to a phenomenal financial crisis. It wasn't the only thing that contributed to it, but it was one of the major things. And the United States banking system required a massive bailout from the Fed, as did banks in other parts of the world as the whole system started winding down. So this is really not a good point to go back to. Second, for many people, income collapsed or disappeared entirely when they lost their jobs after the financial crisis or during the Great Recession. And for many of them, it never fully recovered to the prior level. There are about 60% of the people out there that are now making less money than they used to, whereas there are 10 or 20% that make a lot more than they used to, and in the top third is coming out pretty well. So averaged out, the top and the bottom all together, average wages increased about 24% since before the financial crisis. So that's it's not a lot, but it's spread unevenly. And when it comes to the housing market, we have got to remember that the housing market is for everyone. And when the lower 50% has problems paying for it, then this will be a big reduction in demand. So also inflation during that time rose about 17% according to CPI. So a lot of these households have not even been able to keep up with inflation, and they have less money to spend on housing today than they had back then. Number three, the national averages of home prices that are now up 11% from the peak of the prior bubble, that they really belie the bubbles going on in a number of markets, including in much of the West Coast, so California, Southern California, the Bay Area, there's some Central California parts, then up further north, Portland, Seattle. They all have massive housing bubbles. There are some big housing bubbles on the East Coast. Real estate is local, so it really depends on the local market. And there are plenty of markets in the middle of the country, from Nashville to Denver, that have massive price increases in the markets. So in these markets, home prices are up 30%, 40%, or 50% and more above the peak of the prior bubble. And this is quite something. These are not little markets. These are big markets. They're large and diverse. And when the median home price is up 50% from the peak of the prior bubble, this means that there are large affordability issues. This is why this housing market is called housing crisis in a number of cities, including in San Francisco and Seattle. It's a crisis of affordability, not of availability. There's plenty of housing available, but it's just not affordable at these prices. And so now these high prices are colliding with rising mortgage rate. And that's what's different this time as opposed to last time. We have the most inflated home prices ever, and they're now being treated to higher mortgage rates. But I don't think 5% is the pain threshold. I think there will be potential buyers that will not be able to buy at 5%. But overall, I think the housing market will continue to plod along. There's already some problems in demand and supplies increasing. So in some of these markets that we're talking about, the fundamentals are changing a little bit. But at 5% still, I don't really see the pain. The pain, I think, comes in at 6% or thereabouts, and this will be where a large number of potential buyers will simply not be able to afford the market. But there will be another group of people that can't afford to buy at the level where they intended to, and they will have to step down, and so they'll buy a lower priced home. So the demand curve will shift down, and at the medium and upper ranges, suddenly there will be quite a bit less demand for homes than there were in the good times. And when this demand starts to fade, it will change the underlying dynamics first. So there'll be more inventory in the market because it sells less. There'll be less traffic. There'll be more price cuts and so forth. And there's another group of potential buyers out there, and these are people that already own homes, and they bought their home and perhaps refinanced at 3.5%, and they're living in markets where home prices have risen sharply. So if they want to move, they now have to buy a home, maybe just a parallel move of equivalent value, but instead of 3.5%, they're going to finance their home at 5 or 6%, and suddenly they realize that they cannot make the payments on even a parallel move like that, and so they will stay put. They will not be able to move, and the homes will not come on the market. And they will not create demand. So they're kind of locked in their current homes, and that part of the market is likely to freeze up until prices come down far enough to where these people can move. So when will we get this dreaded 6% for the average 30-year fixed-rate mortgage rate? I think the date will come sometime next year. We're probably 3 or 4 rate hikes away still. I also think that the yield curve will steepen a little bit. The reason for that is fairly basic. Now, a yield curve is where Treasury securities of different maturities have different yields. So the 2-year yield should be lower than the 10-year yield. As the 2-year yield rises and the 10-year yield stays flat, as it has been in the past occasionally, the yield curve tends to flatten, and so the 2-year yield and the 10-year yield are very similar, and the spread between them is fairly small. This has probably run its course. People out there are claiming that the yield curve would invert, that in fact the 10-year yield would soon fall below the 2-year yield. They have said this for a big part of this year, and it hasn't happened yet. It might have happened under different scenarios, but this time around we have the central bank, the Fed, which is unwinding its QE. So it is actually shedding the securities it has bought under QE. So this puts some pressure on long-term yields, and our government is issuing new treasuries at very, very large amounts in fiscal 2018, which just ended at the end of September. It issued nearly 1.3, or it increased its total debt by nearly $1.3 trillion. That is despite a fairly strong economy. So the government spending and the tax cuts combined create a situation where borrowing by the government will increase on a very steep curve. And probably next year, we're looking at an increase in the national debt of $1.5 trillion. Now, investors need to be found to absorb this debt. There needs to be $1.5 trillion in new money coming into the Treasury market to absorb this. And this needs to happen while the Fed is pulling out of this market. So the Fed has stepped away. The Fed is no longer buying. It is now unwinding its QE, and at the same time we've got this flood of treasuries coming on the market, so yields will likely rise just because of the supply issue. To make this investment more attractive, to lure more investors out of the woodwork, yields need to become more attractive, and that will likely push up the long-term yields quite a bit, including the 10 and 30-year yields. The 10-year yield is very crucial for mortgage rates, so mortgage rates will follow that. There's an additional piece of spice here in that the Fed is also stepping away from the mortgage-backed securities market. It had acquired these mortgage-backed securities to push down mortgage rates. That has worked fairly well. It is now unwinding those positions. There is discussions in the Fed that, in fact, they want to get rid of all of their mortgage-backed securities and completely exit that market. So mortgage rates will get all the pressures from the 10-year yield that they normally get, plus they will get the pressures from the mortgage-backed securities market that the Fed is now stepping away from and is unwinding its own positions in these mortgage-backed securities. These are dynamics that we just have not seen before. Never before had the Fed done QE like this. Never before had it acquired Treasury securities and mortgage-backed securities. And never before had it tried to unload them into a market that is now already oversupplied by the government's own issuance of new debt. So this will be a new experience for the market. We have a generation of people on Wall Street that have never seen rising interest rates. So if you entered Wall Street 10 years ago, you have only seen falling interest rates. So there are a number of circumstances coming together that will make this somewhat unpredictable. However, on the positive side, subprime is not nearly as big and bad as it was. The banking sector overall has improved in many ways, and regulations has gotten stricter. Capital ratios are better. Most of the mortgages the banking sector is carrying are fairly pristine mortgages with solid underwriting. On the other hand, banks are now only underwriting about less than half of the mortgages. The majority of the mortgages written today are originated by the shadow banking system, and these are companies like Quicken Loans that have muscled into this space very aggressively by undercutting banks and offering different products and using different technologies, making it easier for customers. These entities are less regulated than banks. They have more leeway. The risks are really piled up in that end of the market, not in the banking sector in the United States. So when we have credit problems, I think it will first hit the shadow banking sector. These shadow banks don't take deposits. Unlike regular banks, they are funded in different ways through bond issuance and through loans and through securitizing their mortgages. So because they don't take deposits, the bank regulators don't really worry about them. That's why they're not regulated by bank regulators. They're regulated by other regulators. And it is very likely that the Fed will let them go if if they collapse. So if 1 or 2 or 3 or 10 of them fail, it will not impact depositors, it will not impact the FDIC, it will not impact savers, it will not impact transactions in the banking system and freeze credit. So there's a good chance that the Fed will just let the market do its thing in the shadow banking system, and it will make sure that the banks themselves don't run out of credit. Now, when they are stepping away, so when the shadow banks become more careful with the lending, this will cause interest rates to rise further in the mortgage area. So this will be another. They're in part responsible for driving down mortgage rates with their aggressive marketing, and a lot of banks have cut back their mortgage activities, including Wells Fargo and many others, simply because they've lost so much business to them. When this competitor suddenly runs into trouble, this will mean that mortgage rates will likely face a less competitive market and may go up for just that reason. So I think housing will run into trouble starting next year, but I don't think there will be that kind of collapse that we saw during the financial crisis. Even that collapse, as rapid as it was, took 4 years to play out across the nation. In some markets, it was a lot faster. In others, it was a little bit more drawn out. I think we will see a more gradual adjustment of the market. There won't be a banking system failure like we had last time. It will be probably the shadow banks that will get in trouble, and they will be let go. And I think the decline, if it's gradual like I seem to think, will drag out for a very long time until some balance is reestablished, and this reversion toward the mean will likely overshoot the mean. So I think long term being maybe a decade, maybe longer, given the current status of the housing bubble. Long term, I think we will look at a fairly unappetizing environment for people in the housing market. Now, people who have bought a home 10 years ago or 15 years ago, or even 5 years ago, and made the mortgage payments, and their income is good and they're in good shape otherwise, they will find that any downturn in the housing market will completely bypass them. They can just ignore it. People who have paid off the mortgages, they're not a risk. The risk is at the lower 10 to 15% of the mortgage market. People who have bought very recently, who have bought at inflated prices, people who are now buying or who will be buying in the next year or two at still relatively inflated prices. People who have bought at low mortgage rates and counted on refinancing in some kind of cash out deal. All these things are starting to be risky, and it only takes the lower 10% of the mortgage market to get in serious trouble to have another mortgage crisis. That's what we had last time. It's not the top 30% or the top 60%. It's the bottom, the most vulnerable 10% to 20% where the crisis happens. So this is something we'll need to keep our eyes on as home prices start to adjust to some sort of reality. There will be some pain, but I don't think it will sink the banking system like the last crisis did, and therefore I don't think the Fed will be using its big guns to try to stop this. And so we'll leave it at that for today. I'm Wolf Richter of WOLFSTREET.com, and this is the Wolf Street Report.